So in this video, I will give you a screening criteria if you are a growth stock trader. Now, please notice I have used three words here: growth stock trader. So we are talking about growth stocks. I am not talking about value stocks here. What is the difference between a value stock and a growth stock? A value stock is a stock where the price has probably come down, the company is available at a bargain price, okay, and the company has good earnings, good margins, things like that, okay. So the company is available at a bargain price. That's a value stock. People like Warren Buffett, Peter Lynch, these kinds of investors look for such kind of stocks. Then there is something called as a growth stock. Growth stock is a stock which has above average return on equity, above average earnings growth, above average sales growth, like explosive earnings and sales growth, because they are in that explosive growth phase. And the stock, the P ratio of the stock is probably very high, okay, towards the upper end of its normal 5-year P range, okay. So it's an expensive stock, but given the earnings growth rate, given the acceleration in the earnings, given the earnings itself, given the acceleration in sales, given the return on equity, the stock, even though it's trading at a high P ratio, could still be undervalued because traders anticipate far more growth ahead, traders and investors alike. So that's a growth stock. And I'm talking about a growth stock trader. I'm not talking about a growth stock investor. What is the difference? So the underlying asset that you buy is a growth stock, but as a trader, I might buy a stock when it forms a base, comes out, when it reaches 20-25%, I might sell partially. And then when it forms another base, I will buy the stock back again. I'll add more shares to my account. So that is trading. As the stock continues to go up and forms new bases, I will continue to trade that stock as it goes up. And when I see signs of topping after base 6 or 7, I would try to come out of the stock. That's called growth stock trading. Growth stock investing means you decide initially how much you want to put into the stock. You say, okay, I will put 10-15% of my portfolio in this stock, and I will not scale up. I will just ride it as long as it continues to show growth, and I might stay invested in the stock for forever. Okay, depends. Growth stock in investing means minimum 3 to 5 years. Trading means roughly 1 or 2 years, 2 years max. But within 1 year, if the stock completes 5-6 bases, okay, even that is enough for a trader to come out with a significant profit from the stock. So that is why I said, please notice I have used three words here: growth stock trader or a momentum trader. So if you are a growth stock trader, in this video, I will give you a screen which will help you to shortlist stocks based purely on fundamental factors. Okay. We are not looking at technicals for now. Okay. I am assuming that the technicals of the stock are in place. What do I mean by technicals? Well, number one, the stock should be an outperforming stock from an outperforming industry, which is already in stage 2 uptrend, which is forming a tight base on the right side, and which is within 20% of its 52-week high. You might want to note this down. You might want to take notes on what I just said. There was a lot in that statement, and I have made a separate video to just explain that statement. That statement is the holy grail for growth stock investors. So let me repeat that statement. Focus on outperforming stocks from outperforming industries which are in stage 2 uptrends, forming tight base on the right side, and which are within 20% of their 52-week high. If you find such a stock, that is a growth stock. Okay. Apart from this, you have to look at the fundamentals. So I will give you a screen in this video where I will talk about 3 fundamental factors. If those 3 fundamental factors are not in your favor, you can just wait for the stock to come up in your radar later. But if you find a stock which fits in these 3 criteria, that stock should be on your watch list. You should not ignore that stock. Okay. So there are three main factors, fundamental factors that make a stock go up. And by the way, this is criteria is only for positional traders, not for swing traders. I hope you understand the difference between swing trading and positional trading. Basically, positional trading means you are holding on to the stock as long as it remains above the 50-day simple moving average, or as long as it remains above the 10-week simple moving average on the weekly chart. That is not the case with swing trade. Swing trading means you might want to get out of the stock within 1 or 2 weeks if you are getting a double digit return. Okay. So, growth stock trading, and that too positional trading. So, three fundamental factors: growth in earnings, number two, growth in sales, number three, return on equity. Okay. So, let's have a look at these factors, and I will tell you the criteria as we look at these factors. So, this is a chart of NVIDIA. Okay. So, if you click here and you click financials, it shows you statements. Click on quarterly, go directly to net income. Okay. So this is your first criteria. Check the latest number. It shows you the percentage increase in that quarter. Okay. Now, how is this number calculated? Well, this represents quarter 2 2024. So you have to go back to quarter 2 of 2023. So quarter 2 of 2023 and quarter 2 of 2024, these two numbers are compared. So as you can see, it has gone from 6 billion to 16 billion. That's a 168% growth. So this, although it is a quarterly growth, but it is measured for one quarter. When you compare, let's say we are looking at June quarter of this year, you have to compare June quarter of this year with the June quarter of last year. And when you see the growth, that is what this number represents. Okay. And the criteria is this number should be minimum 40%, more than or equal to 40%. Okay. 40%. This is a criteria that I have learned from Patrick Walker. Patrick Walker is a veteran trader in the US market with more than 4 decades of experience. So this number should be the recent quarter. This number should be more than 40%, more than or equal to 40%. That's number one criteria. Number two, if this number is not 40%, then what you do is you go here, you look at the sales. Sales, again, the same way the quarterly numbers are calculated. You look at the latest 2 quarters, and then you find the average of those 2 quarters. That average should be more than or equal to 40%. So first, you look at the earnings recent quarter. If this is 40%, you don't have to look at anything else. Okay. However, if this is not 40%, come here, take an average of these two, the revenue. Okay. If that is 40%, that stock should be on your watch list. Apart from this, remember I mentioned the third parameter, which is return on equity. Click on statistics, go down to return on equity, check the latest. Return on equity is 123.77%. Our criteria is minimum 17%, 17%. This is something I learned from William O'Neill because he has done extensive research and found out the characteristics of growth stocks. The minimum required return on equity is 17%. Okay. So as you can see in NVIDIA, all the three criteria are met. Okay. You might find stocks where you will find that 2 criteria are met, but 1 criteria is not met. You might find another stock where only 1 criteria is met, the other 2 criteria are not there. You might find a stock where none of the criteria is meeting. You might find a stock where all the criteria is being met. Okay. So you have to look at all the 3 factors and then take a decision whether you want to go with the stock or not. The more the number of variables in your favor, the better it is. Okay. And by the way, when I say earnings, sales, and return on equity, if you just have earnings growth of 40% or more, that's it. That you don't need to look at return on equity. You don't need to look at the sales growth. Even if 1 criteria is there, that stock should be on your list. And return on equity is the second priority. Main priority is sales and earnings. If both sales and earnings are not there, then don't look at return on equity. Okay. This is one. So please take notes, watch this, whatever I am saying, take notes, watch this video two, 3 times, okay? Because I'm going to tell you another variation of how to use this. Coming back to statements. Now you might encounter a stock where this is not 40%. Okay, it is less than 40%. So in that case, if this number is more than 25%, now this is William O'Neill's criteria. If this number is at least 25%, then look for accelerating growth. So this number should be greater than this number, and this number should be greater than this number. So 3/4 of accelerating earnings, and this number is minimum 25%. Even that is allowed. Okay. So now we are compromising on that earlier 40% criteria, but we are keeping a minimum criteria of 25% and we are demanding accelerating. In the earlier criteria, even if this was negative, but this was 40%, we would still consider the stock. So now you understand this is the second variation. This number should be more than 25%, and the growth rate should be accelerating. Same is the case with sales. This number should be 25%, and this should be more than this, and this should be more than this. So accelerating sales growth, accelerating earnings growth, latest quarter minimum growth rate should be 25% or more for both sales and earnings. So write this down. This is extremely important. First, you look for the basic Patrick Walker criteria. If the Patrick Walker criteria does not get met, then you come down to William O'Neill criteria. And if either one of those criteria gets met, try to look for the icing on the cake by looking at the return on equity. If the return on equity also goes past 17%, that's a stock that should be on your radar. So I hope you have taken good notes here. Start with Patrick Walker criteria. If that is not satisfied, come to William O'Neill criteria. William O'Neill criteria is much simpler to apply than the Patrick Walker criteria. Look at earnings and sales first. That is priority number one. If that criteria is not getting met, just ignore the stock. Okay. If that earnings and sales criteria is met, then you come to return on equity. And if return on equity is more than 17%, that's like the icing on the cake. Okay. I would not reject a stock just because of return on equity. So I hope you understood this. Let's look at one more stock. For example, let's look at Nestle. Nestle India, a very popular company, popular brand. Okay, so this is Nestle India. I will go to financials. I'll click on statements. I will click on quarterly. Let's see. See now, net income. What is the growth rate? 15%. So Patrick Walker criteria is not met. We need that number to be minimum 40%. Here it's 48, but we are looking at latest quarter. Then if this criteria is not met, I will go to the sales. I will try to find the average between these two. Again, if you take the average of the latest 2 quarters, it is not 40%. So there is now, both of the criteria are not met. So there is no point in looking at the return on equity. Okay. Now we switch over to William O'Neill criteria. William O'Neill criteria says this number should be minimum 25%. If it is 25%, then there should be accelerating growth, quarterly growth in the EPS, the net income. Okay. So this number should be higher than this, and this number should be higher than this. As you can see, even the William O'Neill criteria is not being met. And here again, this number should be minimum 25%, and the latest 3 quarters, the sales growth should be accelerating. Again, it is not being met. Okay. So you can read William O'Neill's book. Okay. Look at study the criteria that William O'Neill talks about. I have explained to you the best what I have understood by reading William O'Neill's material and looking at Patrick Walker's material. Whatever I have understood by listening to these legends, that is what I have tried to present in this video. Okay, this is my understanding, and this is how I apply this criteria in my positional trading. So you could do this, or there might be 1 or 2 more screens that William O'Neill gives you, which you might want to consider, because he is also looking at annual earnings growth and things like that. I am purely looking at the quarterly earnings growth. I don't look at annual earnings growth because that is already covered in the EPS rating on the MarketSmith platform. Okay. So this is what I have understood. Okay. And this is what I have presented to you. Now, in this case, you could switch between annual and quarterly. See, if you click annual, you get annual rates of return. You click quarterly, you get quarterly. So TradingView itself is a fantastic platform. Click on statistics, go to annual, find out what's the return on equity. See, it's 108%. Okay, it's a fabulous company. Okay, big money making company. However, just because a company is big in size and has a good competitive position in its business doesn't mean that it is growing at the rate that we want it to grow. Okay, and that is reflective in the stock price. If you look at this price action, it's been dormant for quite a long time. Ever since the start of the year, the stock has been following. So it's already September. Since January, the stock has not been performing. This is because of underperformance. This is because of earnings slowing down, sales slowing down. Okay, so I hope you nailed down this criteria. Just using this criteria, you can reject 95% of all the stocks in the stock market, whichever stock market you are trading in the world. At least 90% you can just reject with this simple criteria. Okay, so I hope this helps you. Please like, comment, and share this video so that other like-minded people or other growth stock positional traders like you will benefit from this video. Thank you so much.